Now to our next session, S&P TSX60 Index Future Trading 101 with Future First Academy and Nitesh Bansal, Vice President of Research and Future at First Academy, will present it. Nitesh, it's up to you.
All right. So I welcome you to this session called S&P TSX60 Index Future Trading 101. I present this session to you on behalf of Futures First Academy. My name is Nitesh Bansal, and I represent Futures First Academy in two capacities. I am the Director of Academics for Futures First Academy, and I also happen to be Vice President Research for Futures First. Before we move on, I would like to share this quick disclaimer with you. It will take a couple of seconds. Please go through it before we start. The objective of showing this disclaimer is to really explicitly say that all the views and opinions expressed in today's session are my own personal opinions. And it's an educational session. That is why nothing in this presentation should constitute or represent financial or investment advice. Okay. The main topic today is speculation in the S&P TSX60, but not using the index itself or using the individual stocks, rather using the SXF, SXM futures, that is the TSX60 regular futures and the mini futures. As part of this session today, we're going to talk about how to use index futures. We're going to look at a couple of examples in terms of understanding how index futures are better at doing that. We would look at some of the pitfalls and problems that do arise in today's world, especially because now the world is about electronic trading completely. And then at the end, we will finish it up with looking at how index futures are ideal in these conditions. Before I start talking about speculation and directly jump onto the strategies and tools, I would like to give a quick 101 regarding futures. Index futures, you can think of them as part of a pipeline where on the left-hand side of the pipeline, you have individual stocks or individual shares of companies such as Enbridge, companies such as Bank of Montreal. So all of those individual shares are there. And then a stock index is a mix of all those individual stocks in certain proportions. That's what is known as a stock index. So for our case, for example, that stock index happens to be S&P TSX60 index. And using that stock index as the base, an index future is created. So the value of that index future is directly dependent on the value of the stock index itself. In our case, that index happens to be S&P TSX60, and the future contracts are SXF, that is the regular futures, and SXM, that is the mini future. So that's how index futures universe is actually tied up with not only its base or underlying stock index, but also the individual stocks. Now, let's look at the features, some of the characteristics of index futures. The way we refer to these index futures characteristics is by calling them MEME. Here, MEME stands for margin, easy to execute, mark to market, and expiry. Let's look at them one by one. By margin, we mean that as a trader or as an investor, when you're using index futures, you're still referring to what is happening in the underlying index. But you do not have to buy the index, or you do not have to invest the actual full monetary value of the index itself. All you need to do is deposit the initial margin and the maintenance margin with the broker. And that number, the initial margin and the maintenance margin, happens to be a lot lower compared to the full monetary value of the index itself. So it helps you leverage the trade. It helps you use less capital for the same exposure. The second feature is easy to execute. Buying and selling an index future is a lot easier than buying the index. If you imagine buying S&P TSX60 index entirely, that would actually entail buying all these 60 individual stocks in their actual proportion in which they are part of the index. And that could sometimes be very difficult. You might get into a lot of trouble because sometimes you might not be able to buy the exact proportion of the shares. Sometimes the value of a single share might be so high that you might not be able to buy even one of them. So index futures do not run into those problems. Buying and selling an index future is like buying and selling any natural product. So if you wish to buy X number of contracts of index futures, it is as easy as buying a product on an e-commerce website. So you click a buy button and you click a sell button. It's a lot different than the way you buy an index. That brings us to the third feature, M2M, or mark to market, also known as daily cash settlement or just daily settlement. All of these are one and the same things. Future contracts, and this is not just about index futures, all future contracts are settled on a daily basis using the settlement price. And the resulting cash at the end of the day is paid or received depending on where the settlement price is relative to your original position. So imagine if you bought an index future contract at a certain price. At the end of the day, the settlement price decided by the exchange happens to be higher than where your original position was, which means you bought it, it has gone up. That means you're making money. Because you're making money, you will receive a credit in your account, in your margin account. On the contrary, if the market goes down, that is, the settlement price happens to be lower than what your original position was, then because you've bought and the market has gone down, you're losing money. And that money is taken from your margin account. Okay, so that's how daily cash settlement takes place, and it's an integral feature of not just index futures, but all types of futures contracts. That brings us to the last important feature, expiry. All futures, unlike an index, have a definite life. The index itself does not have a definite life. The index existed a couple of years back. It will exist a couple of years later as well, a couple of decades later as well. Its constituents might change, but the index will always exist. Futures contracts have a definite life. For example, index futures generally have quarterly expiries. So the next available expiry, for example, now is the December 2021 expiry. After that, you have the March 2022, June 2022, September 2022, and so on and so forth. So they expire on a predetermined date and time, and that, as I said, is predetermined. It is available on the website of the exchanges and is known to everyone who is involved with these features. So that summarizes actually the features. Remember, this is not an exhaustive list of all the possible characteristics of index features. This is just a list of 4 very important features, and it's really a very easy way to remember them. Just remember, MEM stands for margin, easy to execute, M2M, and expiry. Now that one-to-one of index futures and their characteristics is over, let's jump into speculation, and let's see what we mean by speculation and using index futures for speculation. When we use speculation, when we use index futures for speculation, it is not called a regular speculation. It is actually a leveraged speculation. How exactly does that leverage work? And is it beneficial? Is it not beneficial? We will look at that using a couple of examples in the next 2 slides. But what is happening is this. Imagine if you wish to buy an index itself, if you wish to buy all the possible constituents, individual shares of the S&P TSX60 index, and you believe that the prices will go up by 2%, for example, in the next couple of days. That's your speculative strategy. You've already done your analysis using your tools, your indicators, and you believe the market will go up by 2%. The index will go up by 2%. Now, what you need to do is you need to actually buy all the individual constituents in the given proportion. Even if you do it for a single stock, you will have to go and buy that individual stock. But here is the rub. You will have to invest the full monetary value of the individual stock or the index itself. But if you're using index futures, you do not need to do that, because a trader only deposits the margin. We discussed about margin on the previous slide. A trader only ends up depositing the margin and not the full value of the index. And margin typically happens to be quite a small amount compared to the full value of the index, which causes this leverage. What is the impact of the leveraged speculation? If you're not doing a regular speculation, if you're doing a leveraged speculation, it results in amplification of the profit. To be exact, it results in amplification of the return on your investment and obviously the loss as well. We would look at how this amplification actually takes place using 2 examples. But before we jump into those examples, let's look at this interesting fact. Collective action must follow the collective belief. This means collectively as a group, if a particular group believes in something, and not every participant of the group has to believe in it, majority of the participants have to believe in it, then there is a good chance that they will act on it. They will act on their belief. Once again, it doesn't matter whether all participants of the group are actually acting on that belief or not. If majority of them end up doing it, acting on their belief, it will still result in the same action. For example, if a trader believes that the index will rise, there's a good chance she will buy the index futures, because you can't directly buy the index. It's relatively difficult, as we discussed in the features of futures contracts. Similarly, if a trader believes the index will fall, she'll go and sell the index futures. So action is following the collective belief. And we can't really see the belief. We can only observe the action. We can only observe the action in terms of the market movement. So if majority traders are actually buying index futures, how do we know that majority traders are buying the index futures? We can check the movement. Remember, if some of the traders are buying index futures, some of them are selling it, then broadly, market is going to be in a distribution mode, which means you will not really see unidirectional move. If you are seeing a unidirectional move, that means majority of the traders believe in a particular direction. And they're doing it because they already have a belief. Majority of the traders are buying index futures because they already believe that index will rise in future. Because they cannot buy the index, they simply go and do that in the index futures. So here, if you look at the third point, if majority traders buy index futures, they believe the index will rise in future. The belief is the underlying concept here. But how does that belief also come into existence? That brings us to the fourth point. Anticipating the future direction of the index is the prerequisite. Remember, the group is made up of individual participants. So imagine all individual participants are using their own strategies, using their own indicators, using all of that information, they do their analysis and figure out that they believe market will go up in future. That's their analysis. On the basis of that analysis, they have a belief that index will rise in future, and then they go and buy the index futures. They believe it will go up. So the flow actually is from here. You first do the analysis, then you create a belief, and then you do an action. If every single person or majority of the traders in the group are doing it, then this statement becomes true. Collective action must follow the collective belief. As I said, you can't see their analysis. You cannot see their belief. You can only observe their action. So we have to perceive their possible belief or their possible anticipation on the basis of what their action is. Now, if you combine these last 3 points, how do we use all of this information? How do we use this interesting fact? There are 2 ways we can use this interesting fact. First is, if majority traders are actually buying index futures, that means they believe the index will rise in future. That is why they're getting involved with this kind of trade. We can use this to speculate on the direction of the index itself. We can look at what they're doing in the index futures and create an anticipation for the index directly. After a couple of slides, I will show you how we use that to predict the opening value of the index. This is one way or one method of using this information. But interestingly, if you're using this method, what you're doing is you're following what everybody else either is doing or has already done. This is not your own original analysis. That brings us to the second way you can use this information, the information on this slide. That is, originally you do your own analysis. You use your own indicators, you use your own tools and strategies to anticipate the future direction of the index. And once you have the future direction in front of you on the basis of your analysis, you can use that and the fact that index futures are more effective in giving you a better return on investment. You use that concept and then use index futures to trade. Let's look at how exactly leveraged speculation works using 2 examples. We have 2 examples here, very similar examples. First is for an upside scenario when the market goes up. Second is for a downside scenario when the market goes down. We have taken 2 traders here. First is a trader in the index market known as the TSX60 trader. We can also call him or her index trader simply. And then we have the SXM trader. We have used SXM futures as an example here. SXM futures have a multiple of 50 Canadian dollars to the value of the index. So we compare the actions of these 2 traders, index trader and the futures trader. By futures, I mean here particularly SXM futures. Now, here is our scenario. Let's imagine that the original value of the index is 1200. The purchase price will be 50 times of this value, 1200, because SXM futures are a 50 times multiple of the value of the index. That gives us 60,000 Canadian dollars. Now, the index trader, in order to buy the index, will need to invest all of the 60,000 Canadian dollars. But for the futures trader, all $60,000 are not required. This person needs to deposit only $3,000, which is the approximate margin for this kind of a trade for one lot, for one contract. Why is this happening? Why is the futures trader not putting in the entire amount? Look at it this way. If you are the futures trader, in a futures contract, you enter into an agreement to buy something, but not today, after a couple of days, on the expiry. So if you're looking at the December expiry, you will actually receive this index on the expiry. So what you're saying is that as a buyer, if I put in all $60,000 today, I'm not really getting anything in return for that. This person, when this person invests $60,000, this person gets the index. When I'm investing $60,000, all I'm getting is a promise that you will get the index or index value on the expiry 3 months from now. So this person is depositing this amount only for the promise, because all this person has today is just the promise. There is no actual index or actual credit of the index or credit of the shares in this person's account. Hence, the original investment differs for both the parties. The new value, why do we look at new value? Because we are looking at an upside scenario. The index has now gone from 1200 to 1230. So the sale price now for both the parties will be 1230 multiplied by 50 Canadian dollars, which gives you $61,500. And we can quickly calculate the profit, which is sale price minus the purchase price, that is $61,500 minus $60,000, gives you a profit of $1,500. But here is the interesting part. The index trader earned these $1,500 on an original investment of $60,000. That's a 2.5% return on investment. But the SXM trader got the same absolute amount of profit, that is $1,500, but on an original investment of only $3,000. And that's a return on investment of 50%. So when we indicated that leveraged speculation results in amplification of profit, this is what we meant. From 2.5%, we've gone to 50% because of this leverage. Now, if you compare 2.5% and 50%, this is a factor of 20. 2.5% multiplied by 20 gives you 50%. How did this 20 come in? This 20 is actually the leverage. The futures trader is putting up only 1/20th amount of the actual index value. Or in other words, the index trader has to put up 20 times more amount than the futures trader. So if you're looking for quick calculation about amplification of a trade, amplification of your profit, if you would have invested in futures, all you need to do is find out the total leverage, multiply the leverage with the possible return that you're expecting in the index trade, in the spot trade, and that will give you the amplified number in terms of futures. If you notice carefully, if let's say both of these traders are trading this index from the perspective of a day, 2.5% movement in a single day is actually quite large. It doesn't happen every day. So from that perspective, 50% return on investment on futures trade every day is also a very far-fetched thing. So this is just a hypothetical example. What happens if the index moves by 30 points? We see an amplification of the return on investment by a factor of the margin, by a factor of the leverage, which happens to be 20 times in this case. Let's look at the flip side. What happens if the market actually goes down? Both these traders bought the index futures anticipating that the market will go up. But what if the opposite side is true? Now, in this case, what happens is that up till investment, everything is same. This person is still investing $60,000. This person is still investing $3,000. But the index, instead of going from 1200 to 1230, has gone to 1170. We are looking at a symmetric case. It went up by 30 points. Now we are taking it down 30 points. The new sale price is 1170 multiplied by 50 Canadian dollars, which gives you 58,500 Canadian dollars. Profit, simple calculation, sale price minus purchase price gives you $58,500 minus $60,000. That is a loss of $1,500. So symmetric. You had a profit earlier of $1,500. Now you have a loss of $1,500. Interestingly, both the traders lose the same amount, but on a different denominator, on a different original investment. For the first trader, the original investment was $60,000. For the futures trader, it is $3,000, resulting in a return on investment. In this case, it is actually a loss of 2.5% for the first one and 50% for the second one. Once again, a factor of 20. How did the factor of 20 come into the picture? Because the margin or the leverage for this particular contract is 20. If you look at all index futures of the world, you can think of 20 to 40 as a decent range of leverage allowed, but this is not really fixed. It depends from country to country. It differs from exchanges to exchanges. It differs from products to products. For SXM futures, this happens to be approximately 20. So a factor of 20 applies as leverage for SXM futures. So I hope these two examples, these two scenarios, actually upside scenario and downside scenario, and how the amplification actually takes place, gives you a good idea of how index futures can amplify both your trades, both your profits as well as losses. And that is why risk management is one very important skill that is required with futures trading as well. If you let your futures trade run out of the course, then as the market keeps going down, your losses get amplified. You're not simply losing, your losses get amplified. Now that we know how index futures amplify the trade, we look at one possible way how to use index futures, and that is predicting the opening of the index. Okay, you would remember while talking about speculation and using index futures for speculation, I mentioned that collective action follow collective belief. This is a good example of using index futures to predict the opening and that point. Let's look at the example. If a good overnight news comes, index futures may go up while the index might still be closed. So imagine if the index is trading x-axis for us is time. So index is trading like this, and let's say the index has stopped here. Index futures will be mirroring what is happening in the index, but when the stock index has stopped trading, index futures would still be on. Now, anything that happens after this point, after the index has already closed, everything else is in a way overnight event for the index futures. Now imagine some kind of overnight news has come. It might come from early Asian hours, it might come from late American hours, and index futures go up. So this is the result. Index futures have gone up. So let me write F. F stands for futures, and this is I. I stands for the index. Now this is the end of day one for both of them. Now next day what happens is arbitrageurs would look at this divergence. You can see that index futures have gone up. Index was simply not there to do a parallel move to follow up. Professional arbitrageurs would notice this divergence between the previous close of the index and the current value of the futures. And they would notice that the index is actually lagging behind. If next day the index opens exactly at the same price, it makes sense to buy the index because it is not really lined up. It is not really aligned with the index futures. So arbitrageurs would want to buy the index and sell the futures to gain from this mispricing. In arbitraging language, this is known as mispricing because both of them have diverged. If we would graph the difference between the index and the futures, typically it would be something like that, a line which keeps coming back to its average, but sometimes it might misbehave. And that's the opportunity for arbitrageurs. Now, next day when the arbitrageurs actually take this action, remember collective action, collective belief. If a single arbitrager is doing this, and let's say there are many arbitrageurs in that market, if a single arbitrager is doing it, probably nothing will happen because majority of the traders or majority of the arbitrageurs are either not doing it or they might also be doing something opposite unknowingly. So it has to be collective belief. It has to be majority of the people doing it. This action from arbitrageurs will reduce the divergence by bringing the index up. So index eventually goes up because of this action because arbitrageurs are buying the index and they are selling the futures. The futures go down. Eventually, the divergence that you see because of index futures going up would correct itself. What is the result? The result is that if you just notice what is happening to futures and you generally trade index or individual stocks, which are highly correlated with the index, then you would notice that index will end up higher from its previous close if the index futures were already up. So we assume that next day when the market opens, futures open right here. It's not that futures once again open right where they were when the index closed. So that's a fair assumption to make. But if that is true, then at the end of it, the result will be the result of what? The result of the action of arbitrageurs, that the index will eventually end up higher. So if you notice the movement in the futures, in the index futures, it might help you predict the opening. But it is not as simple as what is written on the slide. It is not simply looking at the futures movement and predicting the opening and saying that the index will keep going up in this particular example. Index futures are often used as an indicator to gauge the market open, but this works for only a very brief period. Right? So this is the most important point I want to highlight on this particular slide, that even though you could use index futures to predict the opening, you can't keep doing this multiple times in a day. You can't keep doing this every day and be successful about it. It works only for a brief period, and it especially works if the real moves in the index are being influenced by institutional investors. Institutional investors happen to be large players like pension funds, mutual funds, hedge funds, etc., etc. Some of these players are also professional arbitrageurs, or they might not be a complete arbitrager, but they do employ arbitraging desks. If they are involved, there's a good chance that they will notice this mispricing, they will notice this divergence between the value of the index and the futures, and they would like to correct it. How would they correct it? They would buy whatever is or whatever seems undervalued. They would sell whatever is or whatever seems overvalued to them, hence correcting the misprice. So how is this helpful to you? Two ways. First is, if you notice what is happening in futures, even if you're not trading directly in futures, let's say you happen to trade only the index, or you happen to trade only a couple of stocks individually, you could still look at futures and try to find an implied open for the index, and that might give you a rough idea where your stock might open the next day, or where your stock will be fairly priced the next day. And that is a very important insight right at the open. Second way is, imagine if you already have a position. Imagine if you've already bought a couple of stocks, or maybe the entire index, or maybe you bought an ETF which is aligned with the index. And before all of this happened, before this overnight move took place, you already had made up your mind that I think market probably is not really going to do much. I would like to sell here. The next day, when the market opens, I would like to sell. So if you notice that futures have moved higher and you anyways wanted to sell, because of the upside movement in the futures, it makes sense to wait until the opening, because there's a good chance you will get a much better price if you just wait for the market to remove this mispricing. These are two ways you can use index futures, and the fact that they are very helpful in predicting the opening of the index. That brings us to tools and strategies that a trader can use. Remember, the tools and strategies deployed by any trader depends on her objective. If the objective is minimum risk, then index arbitrage is a great strategy. I showed you an example of arbitrage on the previous slide, wherein index futures have moved up, index hasn't, and that creates an anomaly, that creates a mispricing, a divergence. You can take advantage of that. If you keep doing it right, if you keep executing it right, you will end up getting a little higher return than the risk-free rate in a country. And because it's an arbitrage, there is hardly any risk. So it's a good strategy to deploy if your objective is minimum risk. If your objective is higher returns, if you don't care about risk, if your objective is to get higher returns and naturally accept the risk that comes with it, then directional strategies or speculative strategies should be deployed. And if the objective is somewhere optimal returns, then you're not really in a trading zone, you're more in an investment zone. And that is why investment strategies and investment philosophy should be used, wherein, first of all, you try to find out your own risk profile, you try to figure out what your risk profile is. And from that perspective, you try to figure out how much of your position should be allocated to stocks, to equities, or anything related to them. Because as I showed you on the first slide, index futures are basically akin to the stock market. So if your allocation is small enough, if you can't allocate because of your risk appetite, you can't allocate much, then the amount you would be able to deploy to index futures would also be less. But the advantage is that if instead of using the index or the individual stocks, you use index futures, because of lower investment, the chances of getting a little better return are higher. So you deploy that when your objective is optimal returns. Okay, let's spend some time on pitfalls of index futures. Some of the problems which are quite common in today's world when you trade index futures. First is that competition with large players, for example, institutional investors, I mentioned, pension funds, hedge funds, mutual funds, competition with large players and algorithms is inevitable. If you're trading index futures, you can bet on it that on a single day, you will trade with these people unknowingly multiple times. You will trade with a large player, you will trade with an algorithm, you will probably trade with an algorithm of a large player. So this is completely inevitable. Because it is inevitable, you should accept it and you should think how to handle that. The second complexity is that dividend announcements by individual companies makes the estimation of fair value of a share a little more complex. Finding the fair value of a share is relatively easy if you know the ex-dividend date of a share. But if you do not know that, then it becomes a little complex. But because estimation of fair value of a single share is more complex, imagine estimating the fair value of the index futures, because index futures represents an entire index. In our case, S&P TSX60. That is going to be even more complex because the index is made up of multiple constituents, 60 exact in our case. That would actually mean either knowing or being able to guess the ex-dividend date for all the individual companies. As you can imagine, it's not possible that the ex-dividend date for all of them will be exactly the same. It could be different dates. So when it's known that an ex-dividend date is about to be there, then the estimation of the fair value of the index futures itself becomes a little more complex. That's again a pitfall. So if you are employing an index arbitrage strategy or any other strategy which is based on the fair value of the index and the fair value of the index futures, then take this point into account that dividends will mess up your valuation. These are two very important pitfalls. How do we handle them? The solution is to use a robust set of tools and strategies. If the objective of the trader or the investor is to use or to deploy minimum risk, then you should use index arbitrage as indicated on the previous slide. How using index arbitrage helps taking care of these pitfalls? If you are involved in index arbitrage, there's a good chance that you will compete with algorithms. Most of the algorithms that directly are deployed in stocks of the entire world, not just Canadian markets, everywhere in the world, they work or function on index arbitrage because they're faster at identifying these mispricing, these divergences, and they're able to quickly execute them. But if you're involved in index arbitrage, there's a good chance that not all possible opportunities will be gobbled up by these algorithms. There would still be something left. And if you do it right, despite this competition from algorithms, you would still be able to get some return for minimum risk. Remember, the emphasis for this point is this. This set of traders are going for minimum risk, not for higher return. That is speculative strategy. That is the second point. For speculative strategies, you need to include and you need to use a combination of fundamental analysis, technical analysis, and quantitative analysis. Doing all of this together was a humongous task. It used to be a humongous task 10, 20 years back. Not relatively so much today because a lot of information, a lot of knowledge is available in the world. Plus, the computing power in general for a layperson has increased. So you could use all of that to your advantage. Try to gain as much knowledge about the fundamentals of the individual companies or the index that you're trading. Try to get your tools and indicators ready. There is no point working with hundreds of indicators, even though there are as many in the world. Generally, good traders use anywhere between 5 to 10. Generally speaking, 10 is also an absolute max. People end up using somewhere around 5 to 6 tools. And sometimes they could also be using pretty simple tools which have been shunned by general public as being too simple. So they use them, but they use them effectively. So it's not about how complex your tool is, how complex your strategy is, how complex your indicator is. It is about how effectively you're able to use it. right? To give you a sports metaphor, if you pick up any sports, any person who is playing any sport would have possible shots, possible ways to maneuver in the game. But it's not about the complexity of a maneuver or a particular shot. It's about how effectively you are able to do it. If you compare two players, one of them might be naturally better at doing something than the other person. By looking at that person's performance, it doesn't mean that you naturally employ that as your own strategy. You need to find out whether you're even comfortable doing that or not. How does a sports person do it? They rehearse, they do practice. And in trading, the equivalent is a paper trade or doing a back testing to get an idea whether you're even comfortable with all possible aspects of that strategy. Are you comfortable with entry? Are you comfortable with exit? Are you comfortable placing stops? Does the strategy involve trailing the stops? Is more complex risk management required, maybe because you are using a mix of futures and options, etc., etc. That brings us to quantitative analysis, wherein in the quantitative analysis, you download a lot of data, which could be coming directly from the market or could be from a related market. For example, if you're trying to trade index, you could download data for index futures and analyze that. Or you are trying to trade index futures directly and you download data of related countries, related economies, and then analyze all of them together. Effectively, what you're saying at that point is that all of them, all of those individual economies or markets are supposed to move together because perhaps the theme at that point in time is similar. When you're using speculative strategies, you use a combination of fundamental analysis, technical analysis, and quantitative analysis, and use the fact that index futures will result in amplification of your trade. What makes index futures ideal? Let's look at all those points one by one. We come back to margins. When you are trading index futures, as indicated earlier, you are not supposed to deploy or invest the original or the full monetary value of the index. In our example, the original investment required if you were trading the index itself was 60,000 Canadian dollars. But if you were using SXM futures, the mini futures, you would need to deposit only $3,000, which is a factor of 20. Index futures, because of the use of margins, are easy to use. It's easier for a retail trader to just invest that much capital. But what makes an index future ideal is reasonable margins, because reasonable margins attract more traders. And I would like to highlight that deliberately we have written the word reasonable here. We haven't written low margins. Because if you bring in low margins, if you provide a leverage of, let's say, 1,000 times, wherein for $60,000, you only have to deposit a margin of $60, that brings in excessive speculation in the market. People who are not supposed to be trading, people who perhaps have no idea of what trading means, would simply get involved with the market just because it is cheap, just because it takes only $60 to get involved with the markets. Similarly, if the margins are too high, in that case as well, you are making it limited. As an exchange, you're making it limited. As a product, you're making it limited to a certain set of people, because a certain class of people would not be able to use and deposit that much margin. So margins necessarily need to be reasonable. If your margins are reasonable, it will be more attractive for all types of traders. The more diverse class of traders you have, the more your market will flourish, the more the index futures will flourish. And then you have liquidity. Second point is liquidity. Index futures would be highly liquid if the bid-ask spread is extremely tight, which means if the minimum movement is, let's say, 1 point of the index. For example, if the current index is 1200 and the minimum movement allowed it is either plus 1 point or minus 1 point. Then if somebody is ready to buy at 1200, let me write it down here. Somebody is ready to buy at 1200. Then at the same time, somebody is ready to sell at 1201. This is the tightest bid-ask spread you can ask for, because this is the minimum available. You can't go for 1200.5 because maybe that is not allowed by the exchange. So in this case, you have a tight bid-ask spread. To understand how tight bid-ask spread increase liquidity, you need to look at what would happen if you didn't have it. Imagine if you had 1200 and you had 1210. Here, The person who is willing to buy and the person who is willing to sell, the best bid and the best ask are so far apart that if this person ends up buying at 1210 or this person ends up selling at 1200, both of them in a way will feel dissatisfied. The buyer will feel I have paid unnecessarily a higher amount. The seller will feel I have paid unnecessarily a lower amount. So tight bid ask spread gives you a confidence that as a buyer, whatever price you're getting a fair price at that particular point. Similarly, as a seller, you're getting a fair price at that particular point. Point number 1 and point number 2, reasonable margins and good liquidity always result in good volumes. Despite these 2 points being there in an exchange or in a particular product, if you do not see good volumes, that simply means something else is wrong with the product. It could be the regulatory aspects, it could be other aspects, for example, the taxation laws, etc., in that particular case. And at the end, to provide an incentive to traders, the commission also needs to be low enough. Here we haven't written the word reasonable, we have written low commission, because low commission attracts more traders. So what makes index futures ideal? If you have reasonable margin, if you have tight bid-ask spread, if you have good volumes, if you have low commission, that is what attracts traders to a good index futures such as SXM futures. At the end, I would like to say that you can think of index futures as your Netflix subscription, because all the major change with Netflix was realizing that to entertain yourself, you do not need to own the movie. You need to watch the movie. Same thing here. In order to get the exposure to the market, you do not need to own the stock. You do not need to actually put in the full monetary value of the index. You can get the same value by only paying a fraction of the amount, which is the margin, and hence you can think of trading in index futures very much like buying a Netflix subscription. Remember, Netflix subscription also expires, which is very much like the expiry of the futures contract. Okay, so to summarize today's session, index futures can be used for hedging, speculation, arbitrage, or asset allocation. They can be used in all 4 types of trading strategies. They can be used to predict the opening of the index value. A trader needs to deploy the tools and strategies that match her objectives. Objectives in terms of risk or return. Remember, you can't choose both. Otherwise, everybody would choose low risk and high return. So you could choose only one of them. Minimum risk, high return, or something in the middle. Retail traders will inevitably compete with large investors and algorithms. You cannot avoid that. So take that as a constraint of today's world and then tread carefully. This competition can be handled by using robust tools and strategies, competition from large investors and algorithms. Index futures are more effective at handling directional trades because they simply provide you more bang for the same buck. That brings us to the end of my session